Is mutual funds better than fixed deposits? Come, let's find out through a detailed analysis in this video. Mutual funds and fixed deposits are completely different investment options. So comparing them is somewhat difficult, but let's give it a try so that we have a better understanding of both the investment options. We are going to compare both of them on 5 different parameters. The first one, safety of principal. Mutual funds or FDs, where will be our principal amount safe? Obviously, it will be more safe in FDs and even more safe in bank FDs. Your principal can go down in both equity and debt funds, and there is a more chance of losing your principal amount in equity funds. Let's look at the second parameter, taxation. You have to add the interest that you get from fixed deposits in your taxable income, and you have to pay taxes according to the slab you come under. In mutual funds, there is 2 different type of taxation for equity and debt. In equity, under 1 year is eligible for short-term capital gain. So if you withdraw before 1 year, you have to pay 15% tax. But if you withdraw after 1 year, the tax is only 10%. If you have invested in debt funds, the taxation is same as FD. You have to add the gain to your taxable income and pay taxes according to the slab rate. But there is one advantage in debt funds compared to FD. In FD, even if you withdraw interest or not, whether it is reinvested or not, regardless of that, we pay taxes. Even if it is accrued, you still have to pay taxes in FD. But if you have invested 1 crore in debt funds and the 1 crore has now appreciated into 1 crore 7 lakhs, then you don't have to pay taxes for that 7 lakhs till you withdraw your money. Imagine you have invested 1 crore in a span of 10 years. It has become 2 crores. You absolutely don't have to pay taxes for those 10 years till you withdraw your money. And this is the first point. And the second point is that you have to pay taxes just for the amount that you are going to withdraw. So for example, you have invested 1 crore and it has now become 1 crore 7 lakhs. If you are going to withdraw only 7 lakhs, then even if you come under 30% tax slab, you don't have to straight away pay the tax amount of 2.1 lakhs for those 7 lakhs. But in FD for 7 lakh interest, you have to pay 2.1 lakhs tax. So when you are withdrawing 1 crore 7 lakhs, you are only withdrawing 7 lakhs worth of units. According to capital gain calculation, in those 7 lakhs, there will be both principal amount and gain amount. So the taxable amount will only be 50 to 60,000. And you are going to pay only 30% tax of those 50 to 60,000. It will be even less, like 15 to 20,000. So imagine how big it is a difference of 2 lakh tax in FD and 20,000 tax in debt funds. So what we can learn from this is that even though the rule is same, there's a lot of difference in application. To know this kind of nuances in taxes, you have to approach a professional mutual fund distributor or a financial planner to guide you. The third parameter is that inflation beating return. After the taxes are reduced, the returns will become even more less in fixed deposit. So FDs won't be helpful in beating inflation. When we invest in FD, we have to remember that our money is losing its purchasing power day by day. At the same time, if you invest in equity funds, there is risk, but the rewards are as good as the risk. You can achieve 10 to 12% returns in the long term very easily. We have to remember that in some market phases, actively managed equity funds have reached even 12 to 15% returns. So it is clear that you won't get a inflation beating return in FDs, and you can get a very good inflation beating returns in mutual funds. The fourth parameter is diversification. When we are investing in FD, our fund gets invested in only one FD. So if something like ILFS crisis happens, or if your bank got stuck due to huge loan defaulters, then it would be difficult to retrieve your money back. But if we invest in a mutual fund scheme, the fund manager invests in 30 to 40 debt securities or 30 to 40 different stocks. So even if one company doesn't perform or one company is default, the loss is less and we get more returns than FD. So overall, mutual fund wins in diversification when compared to FDs. The fifth parameter is lock-in period. FD is locked for the time period that you choose in the beginning. And also you can pre-close it, but there is a penalty. In mutual funds, there will be 1% if you withdraw before 1 year, and that's it. After 1 year, there won't be lock-in with the exception of ELSS, which has a lock-in period of 3 years. So overall, mutual fund gives you better liquidity compared with FD. Okay, now let's do a recap. In safety of principal, FD scores more. And in taxation, mutual fund scores more. Mutual fund also scored more in inflation beating returns. And we know that mutual fund is extremely diversified when compared to FDs. We can say that the lock-in period is equal for both. So overall, mutual fund scores 3 points out of 5 and FD scores 1 point. With the last one, lock-in is a draw. If you think we can analyze with more parameters, please share your ideas in comments. I will meet you in another video with more exciting information. Thank you. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free and you can find the link in the below description. Please like and share and do subscribe to Holistic Investment.